Nvidia became the first company in history to hit $5 trillion. 9 months later, Apple overtook it without joining the AI spending race. What the market rewarded instead could redefine the next decade of tech. On July 28, 2026, Apple's share price surged to an intraday high of $342.89, briefly pushing its market capitalization above $5 trillion. Only one other company had ever reached that level before. The move capped a 12-month run in which Apple's stock climbed nearly 60%, defying the broader tech sector's volatility. Less than a year earlier, in October 2025, Apple had crossed the $4 trillion mark, a milestone few thought would be quickly surpassed. The scale of the $5 trillion threshold is difficult to overstate. At that valuation, Apple was worth more than the GDP of most countries, and the market treated each tick above $340 as a test of financial gravity. The price action was fleeting, but it counted. Apple's brief ascent into this rarefied territory was a statement about what the market valued most: enduring demand, pricing discipline, and the power of a product-led portfolio. For a moment, Apple wasn't just a consumer brand. It was a public institution, moving markets with every cent. The handoff in market value happened with remarkable speed. On July 27, 2026, Apple's market capitalization edged past Nvidia's, reclaiming the title of the world's most valuable public company, a position Nvidia had held since June 2025. Nvidia's ascent had been historic. It was the first company ever to cross the $5 trillion threshold, fueled by explosive demand for AI chips and record-breaking infrastructure spending. But as the calendar turned to 2026, the pace of Nvidia's gains slowed sharply. Year to date, Nvidia's stock advanced just 6%, while Apple surged by about 25%. The crossover wasn't a random shuffle. It was a direct reflection of changing investor appetite. As concerns grew over the sustainability of massive AI capital expenditures, capital rotated toward Apple's steadier product-driven model. In this moment, Nvidia stood as the benchmark for the AI era, yet Apple's rally suggested that restraint and consistent cash flow could outperform even the most aggressive bets on the future of artificial intelligence. Apple's path diverged sharply from the rest of big tech in 2026. While Microsoft, Amazon, Meta, and Google poured hundreds of billions into AI data centers, Apple kept its capital spending in check. The company's total capex for the year hovered near $13 billion, a fraction of the $725 billion projected for its AI-heavy peers. Instead of building out massive AI infrastructure, Apple relied on its core strength, the iPhone. The latest iPhone launch saw base prices held steady, even as competitors raised theirs by as much as 5%. This pricing discipline paid off. Global iPhone shipments rose 3%, pushing Apple's smartphone market share to a record 20% in the second quarter. Rather than chase the AI arms race on its own terms, Apple signed a multi-year deal to license Google's Gemini models for an upgraded Siri. The Gemini partnership cost Apple about $1 billion a year, an order of magnitude less than the AI investments of its rivals. This allowed Apple to deliver generative AI features without the risk and volatility of building a giant data center footprint. The irony is clear. After years of criticism for lagging in AI, Apple's caution is now seen as discipline, and investors have rewarded it with renewed confidence. In a market obsessed with the next big thing, Apple's steady approach has become its advantage. The timing of Apple's $5 trillion moment sharpened the spotlight on its next chapter. Just 2 days after the milestone, Apple's fiscal third quarter earnings report would double as Tim Cook's final call as CEO, a rare inflection point for the company's leadership and strategy. On September 1st, Cook will move to executive chairman, handing the reins to John Ternus, a 25-year veteran who led Apple's hardware engineering. The transition is designed for continuity, not disruption. Ternus inherits a playbook focused on product consistency and capital discipline, rather than chasing the high-stakes AI build-out. In the same week, Apple rolled out a new iPhone leasing program with Klarna, giving U.S. customers the choice to pay monthly instead of buying devices outright. This move reinforced Apple's commitment to expanding access through incremental product innovation and flexible finance, not through massive infrastructure bets. The broader debate comes into focus. In an era defined by AI, can a product-led model anchored in steady cash flow and measured risk outperform the capital-intensive push for AI supremacy? Apple's latest moves suggest that the answer is still up for grabs. Thursday's earnings report stands as the first real test of Apple's new valuation. With the stock trading near all-time highs, analysts are scrutinizing whether iPhone-led growth can justify such a premium. Some valuation models point to a disconnect. Apple's share price now implies a market cap that exceeds most fundamental estimates, including discounted cash flow projections and consensus price targets. The company's forward PE ratio hovers above 30, while its trailing PE is over 36, levels that invite questions about how much future growth is already priced in. Attention now centers on Apple's ability to sustain momentum without the massive AI infrastructure bets that have defined this era. Investors want evidence that demand for the iPhone and related services can keep margins healthy, even as rivals double down on capital-intensive AI platforms. The market's risk tolerance is on display. Some see Apple as a defensive play, others as stretched. Meanwhile, the rivalry with Nvidia remains unresolved. Both companies report earnings this quarter, keeping the contest for the world's most valuable public company wide open. If investor sentiment swings back toward AI-driven infrastructure, Nvidia could quickly regain its lead. For now, Apple is the test case for whether measured growth and capital discipline can outlast the AI spending boom. Markets now weigh discipline against ambition. Apple's ascent signals that profit, not just promise, can redefine leadership. In tech's next era, restraint may prove the boldest strategy. Share your thoughts below.